Today we are talking about a direct and important financial update that could affect how millions of Americans, especially seniors, interact with their banks. A new $250 banking rule has officially been confirmed, and while it may sound small at first, it has the potential to change how deposits, withdrawals, stimulus payments, Social Security benefits, and pension funds are processed and protected. This update is not just about a number. It represents a shift in how financial institutions manage certain transactions, monitor accounts, and handle government-related payments for older adults who rely on fixed income such as Social Security, SSDI, SSI, veterans benefits, or pension payments. Understanding this change is essential for financial stability and peace of mind. The $250 new bank rule is connected to updated federal banking compliance standards designed to strengthen fraud detection, improve transaction transparency, and provide additional consumer safeguards. In simple terms, banks are now required to apply enhanced monitoring procedures to certain transactions that meet or exceed a $250 threshold under specific conditions. This does not mean that every $250 transaction will be blocked or delayed. It means that certain patterns, especially unusual activity tied to direct deposits, transfers, or withdrawals, may now trigger additional verification steps. These protections are meant to reduce fraud, identity theft, and unauthorized withdrawals, which have increasingly targeted retirees and older Americans. For seniors who depend on monthly government payments, the most important thing to understand is that this rule is not a cut to benefits, and it is not a reduction in payment amounts. Social Security payments, pension checks, and other federal benefit deposits remain intact. However, the processing environment around these funds is becoming more secure and more closely monitored. Financial institutions are required to document and verify suspicious movements of money more quickly than before. In some cases, if an unusual $250 or greater transaction appears inconsistent with an account's history, the bank may temporarily review it for security purposes. This development comes at a time when federal authorities have emphasized the need for stronger financial protections for seniors. Fraud schemes targeting retirees have increased over the past several years. Scammers frequently attempt to access bank accounts shortly after Social Security or pension payments are deposited. By tightening oversight around certain transaction levels, regulators aim to interrupt suspicious activity before significant losses occur. The $250 threshold is part of a broader fraud prevention framework, not a penalty or restriction placed on seniors. It is also important to understand how this rule interacts with stimulus-style payments or cost of living adjustments. When federal authorities approve increases in Social Security payments or distribute special financial relief, those funds are typically deposited directly into bank accounts. Under the new rule, these deposits themselves are not limited or reduced. However, if the funds are quickly transferred out in unusual patterns, the bank's internal systems may review those transfers for security reasons. This review is designed to protect account holders from unauthorized activity rather than to interfere with legitimate spending. Many retirees manage tight budgets, often withdrawing or transferring amounts close to $250 for utilities, rent contributions, insurance premiums, medical bills, or household expenses. Everyday spending continues normally. The rule focuses primarily on patterns that differ significantly from established account behavior. For example, if an account that usually maintains steady monthly expenses suddenly initiates multiple rapid transfers to unfamiliar accounts, enhanced verification may occur. This safeguard is especially important for seniors who may be targeted by phone scams requesting urgent payments. Another key aspect of this change involves faster reporting requirements between banks and federal oversight systems. Financial institutions are now expected to flag certain transaction patterns more efficiently when they involve government benefit deposits. The intention is to reduce the window of opportunity for criminals who attempt to drain accounts shortly after deposits arrive. For seniors receiving fixed monthly income, this provides an added layer of protection that did not previously exist at this level of monitoring. The $250 rule also connects to internal banking policies regarding holds and verification procedures. While routine transactions proceed as usual, banks may request confirmation in situations where there is a high risk of fraud. This might involve verifying identity through secure methods before approving certain outgoing transfers. These steps are meant to protect the account holder and ensure that legitimate funds remain secure. Seniors who maintain consistent spending habits are unlikely to experience disruptions. In addition to fraud prevention, the updated framework encourages clearer communication between banks and customers. Institutions are expected to notify customers more promptly if a transaction is under review. Transparency requirements have increased, meaning account holders should receive clearer explanations when security checks are applied. This is especially valuable for retirees who rely on predictable access to their funds. For those receiving Social Security retirement benefits, SSI, SSDI, railroad retirement payments, or federal pensions, the primary takeaway is stability. Monthly payments continue as scheduled according to established deposit calendars. Cost of living adjustments remain determined by federal guidelines. The $250 rule does not reduce benefit amounts, change eligibility criteria, or alter payment dates. Instead, it enhances oversight around how funds move after they enter the banking system. The timing of this rule reflects broader financial modernization efforts across the United States. As banking becomes increasingly digital, fraud techniques have become more sophisticated. Seniors are often targeted through phishing calls, fake government impersonations, and urgent payment demands. The updated monitoring threshold is one of several measures designed to strengthen defensive systems within banks by applying structured oversight at manageable transaction levels. Regulators aim to prevent small losses from escalating into major financial harm. For older adults who prefer in-person banking, daily interactions remain unchanged. Depositing checks, withdrawing cash, and speaking with bank representatives continue as before. The internal monitoring systems operate behind the scenes. Customers do not need to fill out new applications or sign additional forms solely because of this rule. The changes are operational and regulatory rather than procedural for everyday banking tasks. It is also worth noting that this rule works alongside federal deposit insurance protections. Funds held in insured accounts remain protected within established limits. The new monitoring standards do not replace insurance coverage, but instead add another protective layer focused on transaction security. This combination of insurance safeguards and transaction oversight creates a more comprehensive safety net for retirees. For seniors managing joint accounts, especially those with spouses or caregivers, communication becomes even more important under this framework. While legitimate shared expenses proceed normally, unusual third-party transfers may prompt verification. Maintaining clear records and awareness of regular expenses can help prevent confusion if a review occurs. Consistency in banking behavior generally minimizes interruptions in the context of potential future stimulus-style payments or emergency financial relief programs. This updated system ensures that deposited funds are less vulnerable to rapid exploitation. When government agencies authorize additional payments, recipients can feel more confident that their accounts are protected from unauthorized access immediately after deposit. This reassurance is particularly important during periods of economic uncertainty. As financial systems evolve, small regulatory thresholds often signal broader structural improvements. The $250 marker may appear modest, but its role within automated monitoring systems allows banks to detect irregular activity earlier. Early detection often means faster intervention and reduced losses. For seniors living on fixed incomes, even small financial losses can have significant consequences, so preventative safeguards carry substantial value. Overall, the $250 new bank rule represents a shift toward proactive financial security rather than reactive correction. Instead of waiting for fraud to occur and then investigating, institutions are now empowered to monitor and verify in real time. For retirees, this creates an environment where monthly benefits, pension income, and savings are better shielded against evolving threats. As we continue this important discussion, it is essential to focus on what this new $250 bank rule truly means for seniors who rely on steady monthly income from Social Security, disability benefits, veterans payments, and private or public pensions. The rule itself is not a reduction, not a penalty, and not a new fee. It is part of a broader financial protection structure designed to guard retirement income in a rapidly changing digital banking environment. For older Americans living on fixed incomes, predictability is everything. Monthly deposits arrive on scheduled dates, bills are paid according to careful planning, and savings are preserved for emergencies. Any regulatory change can create concern, but this update is centered on security rather than restriction. Over the past several years, federal authorities have emphasized consumer protection in the financial sector. Seniors have increasingly become targets of scams that attempt to redirect or quickly withdraw funds shortly after government deposits are made. Criminals often exploit predictable payment schedules, knowing exactly when Social Security or pension funds arrive. By introducing enhanced monitoring at certain transaction levels, including around the $250 threshold in defined circumstances, banks now have stronger authority to identify irregular activity early. Early identification reduces the risk of cascading financial harm. For retirees who budget carefully, the most reassuring fact is that normal financial life continues uninterrupted. Routine withdrawals for groceries, utilities, rent contributions, insurance premiums, prescriptions, and everyday expenses proceed as they always have. The rule does not block spending. It does not place limits on how seniors use their own money. Instead, it empowers financial institutions to temporarily review transactions that appear inconsistent with a person's established history. This is particularly valuable when fraudsters attempt to pressure older adults into sending urgent payments under false pretenses. The relationship between this banking rule and government benefit payments deserves clear explanation. Social Security retirement benefits, supplemental security income, disability payments, and federal pensions remain governed by existing eligibility standards and cost of living adjustment formulas. If there is a yearly increase due to inflation, that adjustment continues according to federal guidelines. If there are special relief payments authorized during times of economic hardship, those deposits are processed through established Treasury systems. The new monitoring rule does not alter the amount or timing of those payments. It simply adds oversight once the funds are inside personal bank accounts. In practical terms, this means seniors should continue managing their accounts as usual while remaining attentive to communication from their bank. If a transaction ever requires verification, banks are expected to provide prompt notification and clear explanation. Responding calmly and confirming identity when requested helps ensure quick resolution. These verification steps are safeguards, not accusations. They exist to protect the account holder from unauthorized access or exploitation. Financial stability in retirement depends not only on income, but also on protection. Many seniors operate within narrow margins where even a few hundred can represent a significant portion of monthly resources. A fraudulent withdrawal of $250 or more can disrupt bill payments, delay prescription refills, or create emotional stress. By strengthening oversight around certain transaction behaviors, regulators aim to reduce those risks before they escalate. Prevention is always less disruptive than recovery after loss. Another important consideration is digital banking. More retirees are now using online portals and mobile applications to monitor deposits and manage payments. While this convenience improves access, it also increases exposure to cyber threats. The updated rule complements modern security tools such as multi-factor authentication and real-time alerts. Together, these systems form a layered defense designed to keep retirement funds secure without interfering with legitimate use. For seniors who prefer traditional in-branch banking, the day-to-day experience remains familiar. Tellers, customer service representatives, and account managers continue providing assistance as before. The monitoring mechanisms function behind the scenes within automated systems. Most customers will never notice any operational difference. The value of the rule becomes visible primarily when suspicious patterns are detected and halted before damage occurs. This development also reinforces the importance of communication within families. Many retirees share financial responsibilities with spouses or trusted caregivers. Maintaining transparency about regular expenses and authorized transfers helps ensure that legitimate activity is recognized as normal. When accounts show consistent patterns, monitoring systems are less likely to initiate unnecessary reviews. Stability and clarity in account behavior contribute to smooth banking operations. Looking ahead, the financial landscape will likely continue evolving. Regulatory adjustments often signal preparation for broader modernization. As electronic payments, direct deposits, and digital transfers become increasingly central to daily life, institutions must adapt to protect consumers. The $250 threshold is one component of a comprehensive strategy aimed at safeguarding vulnerable populations, particularly seniors who depend on fixed retirement income. It is also important to emphasize emotional reassurance. Change can create anxiety, especially when it involves money. Understanding that this rule is designed to shield funds rather than restrict them helps reduce uncertainty. Seniors who stay informed, monitor their accounts regularly, and communicate promptly with their banks can navigate this environment confidently. The foundation of retirement security remains intact. In conclusion, the $250 new bank rule represents a shift towards stronger financial protection in the United States banking system. It does not reduce Social Security payments, does not alter pension eligibility, and does not impose new spending limits. Instead, it enhances monitoring systems to detect irregular activity more quickly and protect retirement income from fraud. For seniors who rely on predictable monthly deposits, this added layer of oversight provides valuable reassurance in a time when financial scams have grown more sophisticated. Understanding this update empowers older adults to move forward with confidence. By staying informed and maintaining consistent banking habits, retirees can continue managing their finances smoothly under the updated framework. Retirement income, government benefits, and personal savings remain secure within a system that is becoming more proactive in defending against financial threats. Subscribe USA MOE Guide channel for latest updates.